At 8:30 this morning, the metals market did something it only does when the system is slipping. Gold didn't edge higher. Silver didn't tick up. They detonated upward like somebody just pulled the fire alarm inside the currency building. And that's the part most people are missing. This is not a normal rally. This is a warning flare. I'm John A.G., and you're watching The Currency Academy by John A.G. Here's what happened. The first weeks of the year were supposed to be quiet, slow volume, New Year complacency. Wait until February. That was the script. Then gold ripped through resistance like it wasn't even there. Silver followed like a shadow, snapping higher with the kind of speed that usually shows up right before the crowd realizes the game has changed. And you can feel it. You can feel that the market is not being pushed by excitement. It's being pulled by fear. Because when gold climbs hard while the world pretends everything is stable, it's not a celebration. It's an escape route being built in real time. Now, before we go deeper, I want you locked in for the full breakdown, because the next few minutes matter more than the price chart. This move is being driven by three forces at the same time: physical pressure, dollar fatigue, and policy stress that's reaching its limit. Most people will only notice the candles on the screen. You're going to understand the engine underneath. Let's start with the part that exposes the lie. Spot price is a number. Physical metal is a supply chain. Those two things can drift apart in a hurry when demand stops being theoretical. When the market is calm, paper and physical move together. Dealers have inventory. Mints have schedules. Wholesalers have product. Everyone behaves. But when the market wakes up, the first signal is not price. It's friction. Premiums widen. Delivery dates stretch. The in-stock buttons quietly disappear. And the market shifts from buying what you want to buying what you can actually get. That is already happening. And here's the most dangerous part of that friction. It doesn't show up evenly. It shows up in pockets, then spreads. One dealer looks fine, the next one is empty. One product is available, the next one is gone. One day shipping is normal, the next day it's 2 to 4 weeks. That inconsistency tricks people into thinking there's no problem, because they can still find something if they search hard enough. But that is exactly what the early stage of a squeeze looks like. It's not silence, it's a slow tightening of the pipe, until one day the tap turns and nothing comes out. It's a slow tightening of the pipe until one day the tap turns and nothing comes out. And when that day arrives, price doesn't negotiate. Price jumps, and it jumps without warning. And the reason it matters is simple. A paper rally can reverse in 5 minutes. A physical squeeze doesn't care about your 5-minute chart. Because once metal leaves the pipeline, it doesn't come back quickly. It gets locked into hands that are not trading. They are storing. They are hoarding. They are refusing to sell into noise. That is how markets go from orderly to violent. Now you might be thinking, okay, so people are buying. That's normal. We've seen hype before. No, this is different. In a hype cycle, people buy because they want to win. In a stress cycle, people buy because they don't want to lose. And those are completely different emotions. Winning is optional. Not losing feels urgent. That's what creates stampedes. And stampedes don't need everybody. They only need enough people to show up at the same door at the same time. Because the metals market is not built for a global rush. It is built for steady. And when steady demand turns into aggressive demand, the system starts to stutter. You've seen it before. A mint pauses. A dealer caps orders. A wholesaler stops quoting prices without a timer. People laugh and call it incompetence. But the truth is darker. Those pauses are stress responses. They happen when the move is so fast that normal operations can't keep up without someone getting destroyed on the spread. And the moment buyers see paused or limited, they don't calm down. They speed up. Scarcity is gasoline. So the rally feeds the squeeze, and the squeeze feeds the rally. That's the loop. Now let's talk about the second force, dollar fatigue. Because this gold and silver surge isn't just about metal. It's about trust. Trust in policy, trust in institutions. Trust that the rules won't change again the moment you start winning. For years, the system trained people to believe money is a number on a screen, a balance, a digital receipt. But people are waking up to something uncomfortable. If your money can be printed, diluted, frozen, tracked, taxed, and redefined, then it's not money, it's permission. And permission can be revoked. That realization is spreading faster than official narratives can control. That is why gold is moving like a pressure valve. It's not asking for attention. It's reacting to stress building behind the scenes. And silver is moving with it because silver isn't just a monetary metal anymore. Silver is a strategic material, energy, electronics, defense, solar, industrial systems that can't function without it. So silver becomes the bridge between fear and necessity. Gold is the trust trade. Silver is the trust trade plus the supply chain trade. And when they rise together, it usually means the world is getting more fragile than the headlines admit. Now here's the part where I need you to lean forward. Because there is a trap in every rally. The trap is waiting for confirmation. People want the headline. They want the big bank to declare it safe. They want the mainstream anchors to say, yes, now is the time. But the moment the mainstream blesses it, the easy window is already gone. That's how narrative works. First, it's ignored. Then it's mocked. Then it's reluctantly acknowledged. Then it's celebrated. And by the time it's celebrated, the crowd is late, emotional, and chasing at the highest prices. So if you're waiting for a green light from the same people who denied the problem for years, you're waiting for permission to get squeezed. That's the psychological warfare. And it's why this rally feels like it has teeth. It's not a trend, it's a transition. Now let's lay out the 3 pressure points that could turn this from strong start into historic year. First, the debt engine. Debt is no longer a burden. It's a machine that feeds itself. More debt requires more interest. More interest requires more borrowing. More borrowing increases the debt, and then the interest grows again. This isn't political, it's mechanical. And the system has a breaking point, not when the debt becomes large, but when markets stop believing it can be managed without sacrificing the currency. That's when you see the real shift. Risk premiums rise, auctions get shaky, funding costs creep upward, and the government faces the choice it always faces: cut spending, raise taxes, or print. You already know which lever gets pulled, because printing is the only lever that delays pain without requiring votes. And every time that lever gets pulled, gold gets a new floor. Second, the treasury market. This is the part nobody wants to talk about out loud because treasuries are the spine of the global system. They're collateral. They're benchmark rates. They're the risk-free assumption that everything else leans on. So when you start seeing repeated signs of indigestion, weak demand, unexpected yields, it's not a small story. It's the foundation wobbling. And foundations don't need to collapse to create chaos. They only need to shake. Third, hidden leverage. Commercial real estate, private credit, structured debt, off-balance sheet exposure that looks harmless until refinancing hits higher rates. This is the slow fuse. Loans were written in a world of cheap money and high optimism. Now the bills are coming due in a world of higher rates and weaker reality. And the scary part isn't that a building loses value. The scary part is that exposure is connected. Banks, funds, insurance, pension systems. When one corner gets marked down honestly, the whole structure starts demanding truth. And markets hate truth, because truth removes the illusion of safety. And when the illusion breaks, money runs. That's when gold and silver don't rise. They reprice. Now, I want you to notice something. None of these pressure points require a dramatic headline to be real. They can build quietly. And then suddenly, one small event reveals the entire crack. A bond auction with weak demand. A surprise emergency facility. A bank temporarily restricting withdrawals in a small region. A geopolitical move that changes trade settlement overnight. The spark is usually small, but the gasoline is everywhere. Debt is gasoline. Leverage is gasoline. Overconfidence is gasoline. And the belief that central banks can smooth everything forever is gasoline. And the year just started, which means the system has a long runway to slip, wobble, and crack. Now let's talk about the Federal Reserve drama, because it's getting weird. You're watching this tug-of-war play out in public. One side wants lower rates yesterday. The other side wants to look independent while quietly keeping the system from breaking. And the market is sitting there like a jury waiting for the next mistake. Here's what you need to understand. High rates expose leverage. Low rates expose the currency. There's no perfect path. If rates stay elevated, weak debt breaks. If rates fall fast, purchasing power breaks. So the real question is not, what will they do? The real question is, what breaks first? And that question is exactly why gold and silver are acting like they have a countdown timer, because markets can smell the dilemma. Now, let me hit you with the street-level version of this. You don't need inflation to be dramatic for your life to get more expensive. You just need the quiet theft to continue. And that's what people are finally noticing. So you hear inflation is cooling. Then you go to the grocery store. You renew insurance. You pay rent. You deal with subscriptions. And you realize the old prices didn't come back, because cooling doesn't mean cheaper. It means the loss is continuing at a pace that sounds nicer on a press release. So people adapt. They stop trusting savings accounts as safety. They stop trusting promises as protection. They look for assets that don't rely on someone else keeping their word. That's why metals matter. Not as a lottery ticket, as an exit door. Now, I want to give you a mental model that will keep you sane during fast markets. Stop anchoring on the perfect spot price. Anchor on your plan. Okay? Because perfection is how people miss the move. The market does not ring a bell at the bottom. It does not send you a polite invitation. It moves first, then it explains itself later. So if your strategy is, I'll buy when it's obvious, then your strategy is, I'll pay the highest premium. Now, that doesn't mean you go all in like a gambler. This is not about emotional chasing. This is about disciplined accumulation. Think like a builder. You don't pour the whole foundation in one night. You build in layers. You buy in tranches. You leave flexibility, because volatility is the price of admission. And the market loves to punish rushed decisions. Now, here's where we talk about the part most people get wrong. Paper metals versus physical metals. Paper has a role for trading, for some strategies, for some liquidity. But paper lives inside the system. It has counterparty risk, it has rule risk, it has settlement risk. And when stress hits, paper can be changed by policy. Physical is different. Physical is your receipt outside the system. It doesn't need permission. And that is why, when real stress arrives, physical demand becomes the real signal. Not because paper is useless, but because paper is controllable. Physical is not. That's why you see premiums act like a truth detector. Spot can dip while premiums stay elevated. Spot can be down while availability is shrinking. That's the market telling you the paper number is lagging reality. And that's what makes this rally dangerous for anyone who is only watching the chart. Now, I promised you one thing to watch like a hawk, because if it flashes, it changes the pace of everything. Here it is. Watch the behavior of regular people, not traders, not hedge funds, regular people, because institutions move by models. People move by emotion. And when the public rush starts, it doesn't announce itself politely. It hits like a wave. The moment you start hearing the same phrases everywhere, that's the signal. Where do I buy? What's the best coin? Is it too late? Should I wait? That's when the market transitions from orderly to frantic. And frantic markets do not respect logic. They respect availability. Now, I want to pull you into a quick reality check. This rally is happening while the world is still pretending everything is normal. That is the tell. If we were already in a visible crisis, metals would be expected to move. But when metals move before the crisis is acknowledged, it means the smart money is positioning before the narrative shifts. And narratives always shift late. Now let's talk about global settlement, because this is the slow earthquake under the entire system. The world is experimenting more openly than ever with settling trade outside the dollar. Regional arrangements, alternate rails, gold-backed settlement between certain partners, not because they hate the dollar, but because they don't want to be hostage to a single switch. And even if those moves are small today, they matter because they create a path. Once a path exists, adoption can accelerate fast during stress. And here's the part that most people miss. You don't need the dollar to collapse for this to matter. You just need external demand for dollars to weaken at the margin. Because when dollars aren't needed abroad, they don't vanish. They come home. And when they come home, they chase the same finite goods and services. That's inflation pressure. That's why the currency story is the real story. You can't print your way out of debt without printing your way into a currency problem. You can't solve a currency problem with speeches. Now, let's turn this into action. Because knowledge without action is entertainment, and entertainment won't protect you. So here's the practical playbook for 2026. Step 1, define your purpose. Are you stacking for insurance? Are you hedging against purchasing power loss? Are you speculating for upside? Your purpose controls your strategy. If you don't know why you own it, you won't hold it when volatility hits. Step 2, understand liquidity. In calm times, liquidity feels infinite. In stress times, liquidity is a mirage. The market looks liquid until everyone tries to do the same thing at once. Then it becomes a bottleneck. That's why physical availability matters more than you think. Step 3, avoid emotional extremes. Don't freeze waiting for perfection. Don't chase like a maniac at peaks. Build with discipline. Layer entries, stay consistent. And let the trend work for you. Because the people who win in transitions are not the people with the loudest opinions. They are the people with the strongest process. Now, I want to hear from you, because the comment section is where we expose the signal. Which pressure point do you think breaks first this year? The debt market, the treasury auctions, commercial real estate, or geopolitics? Pick one and tell me why. And second question, are you leaning more gold, more silver, or staying balanced right now? Drop it below. I read these, and your answer helps everyone see the crowd psychology in real time. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment John A.G. Best so I can see you. Now, let's close this out with the part people need to hear. This is not a straight line move. Transitions are messy. They're full of fake outs. They're full of headlines designed to distract you. They're full of sudden dips meant to shake weak hands out right before the next leg up. So don't let the market rent space in your head. You don't need to stare at the ticker every 5 minutes. You need to understand the direction. More debt, more intervention, more control tools, more currency dilution. That is the backdrop. And hard assets are reacting to it. So set your rules now. What you'll buy, how often you'll buy. What levels would make you pause? Then follow those rules when emotions spike. Because discipline is how you keep control. Gold and silver are not just moving. They are signaling. They are warning. They are telling you the system is entering a new phase. And if you understand that now, you're ahead of the crowd that won't wake up until the headlines scream. Take care of yourselves, take care of each other, and I will see you in the next video soon.